When should a trader use a liquidity pool instead of a traditional exchange? In today's rapidly changing financial landscape, many traders are asking a pressing question. When should a trader use a liquidity pool instead of a traditional exchange? With recent developments in decentralized finance, the conversation around trading platforms has become increasingly relevant. Traders are keen to understand the differences between centralized exchanges and liquidity pools, especially as more people explore decentralized options. Centralized exchanges, or CEXs, operate using order books where buy and sell orders are matched instantly. This allows for fast execution and generally high liquidity. However, users must deposit funds into the exchange's custody, which raises concerns about asset security. Fees on these platforms typically range from 0.1% to 0.5% per trade. Additionally, centralized exchanges enforce regulatory compliance measures like anti-money laundering and know your customer protocols, which can limit user anonymity. On the other hand, decentralized exchanges, or DEX, utilize liquidity pools. Instead of matching orders, they rely on automated market makers that use pools of tokens supplied by liquidity providers. This model allows traders to swap tokens directly against these pools, providing continuous access without centralized control. Fees on DEX are generally lower, around 0.3%, and these fees are shared with liquidity providers as incentives. A trader might choose to use a liquidity pool when looking for lower fees and wanting to avoid the risks associated with centralized platforms. With liquidity pools, users trade directly from their own wallets, maintaining control over their private keys. Transparency is another advantage. All transactions are recorded on the blockchain, allowing for public verification. Additionally, liquidity pools operate around the clock, unlike some centralized exchanges that may have maintenance periods or regional restrictions. This continuous access can be a game changer for traders who need to act quickly. Liquidity pools also offer trading pairs that may not be available on centralized exchanges, expanding options for traders. Moreover, traders can benefit from reduced risks of front-running and order manipulation, which can occur in traditional order book systems. Automated market makers execute trades based on the pool's state, minimizing these risks. However, traders should remain aware of potential risks, such as impermanent loss for liquidity providers, and sometimes lower liquidity compared to major centralized exchanges. For traders prioritizing decentralization, lower fees, and direct control over their assets, liquidity pools may be the better choice. Conversely, for those who value fast execution and regulatory compliance, centralized exchanges may still be preferable. In the end, understanding when to use a liquidity pool versus a traditional exchange can significantly impact a trader's strategy and success in the evolving financial market.